How do you overcome the fear of taking the trades when you are making losses on a consistent basis? And what is a trading system? What is the safe option selling strategy with less adjustments? Is trading really profitable or not? These are some of the questions that we have received from our followers when we have put up a Q&A session on Instagram. Some of them are repetitive. We have picked around 10 questions and I'll be answering them one by one now. Let's get started. Question 1. How do you overcome the fear of taking the trades when you are making losses on a consistent basis? Obviously, I can relate to this particular thing because in the initial stages, it happened to me as well, and it can take a huge toll on your confidence level. You will not be interested or even fearful to enter any new trades. See, many people, what they'll do when they face huge loss, they want to recover as soon as possible or they'll quit trading. These are the two things that they can do. But instead of that, there's an option to sit back and then analyze what are the mistakes that you are making. You need not trade for like 2-3 weeks and then just sit aside and then try to find out all the mistakes that you made. There could be 3 major mistakes. One is you are not having a proper technical analysis or a strategies to take the entry or exit. Second thing could be you are following the wrong risk management system. That means your risk management is not proper. Either you are risking more or you are keeping the wrong stop losses, etc. Third one is you are unable to manage your emotions in the live market. These are the 3 main reasons. So you need to sit down and then find out all your last 1 month or 2 months of the trades from when you start to make losses continuously, and then find out where you can improve upon. And when you are starting out again, try to cut down your position sizing to half of it. If previously if you're taking like let's say 200 stocks, now you take only 100 stocks. That can help you to enter the trades in a confident manner, provided you worked upon your mistakes. So that can be the solution. Number 2. So what do you consider is the safest option selling strategy without the need of making much of adjustments? See, when it comes to the safest option selling strategy, there is nothing very specific like that because every strategy will have its own risk. And when it comes to the directional perspectives, and if you want to make a limited loss, of course there are some spread strategies. But the main question is what happens when you are having a non-directional perspective? That means you don't know whether you are bullish or bearish. In that case, we obviously go for strangle positions. But the strangle positions main risk is that you might be having undefined loss if it goes up heavily or goes down heavily. So what you can do, try to create a strangle with a range, weekly strangle with a range of approximately 5 to 6% on each of the sides, not targeting more than 1% of ROI. So your maximum target will be 1% of ROI and your maximum loss also will be 1% of ROI. Since you have a bigger range, you can try to play safely in that area, and it would be requiring very less adjustments because even if there's a gap up of 1% or 1.52%, you won't get into losses easily because your profit target is very less, so that it will be manageable. That you can try. Question number 3. Is trading profitable or not, as many of the traders are losing money in the market? Obviously, it's a well-known fact that like 95% of the people who trade will be losing substantial portion of their capital in 1 year or the 2 years of starting their trading. And it's logical enough because it takes time to get stabilized in the market, even 6 months or 1 year or 2 years or even more, depending upon the skills that you have and the efforts that you are putting out in learning the trading. In the meantime, you may even blow up multiple trading accounts, like I have done, like 3 to 4 trading accounts have been blown up in the initial stages. Now the thing is, if you take out any particular losing trader journal and then figure out what is the mistake that he is doing, it could be either over trading or revenge trading or taking the trades out of FOMO or like taking the trades without proper risk management, or they are unable to control the emotions in the live market. By putting out all these mistakes, if you are not correcting those and then saying that like it's not getting profitable for me, obviously that's what will happen, and that is why many people will not sit and work upon the mistakes. They can either work on those mistakes and then improve themselves, or leave the trading thinking that it's not working out for them and leave a negative impression on trading for the rest of their lives. So the choice is depending upon the trader. Question number 4. What is a trading system? The trading system can have a different definitions, but essentially your trading system has to answer the following questions. Basically, what you're trading. Are you trading in equity, futures or options, intraday or positional? You need to define that particular thing. Then if you're trading in, let's say, equity or options, whatever it is, do we have the proper strategies or do we have the proper knowledge to trade in that particular thing, like entry strategies or exit strategies or the stop loss management and all that? Then comes to the third one, which is the capital management. How much capital you're deploying, let's say if you're doing both intraday and positional trading, how much capital you are deploying for intraday, how much capital you are deploying for positional. In positional, what is your allocation between the different sectors or between different stocks in your portfolio? This all comes under capital management. Then comes to the risk management. How much risk that you are taking per trade and how much risk that you can tolerate per day or per week or per month, like that. These are the maximum drawdowns that you can manage and that you need to define in your trading system. So these are the points that you need to define. And it's not like you created the trading system once and then leave it like that. You need to constantly improvise the trading system depending upon your knowledge or experience that you are getting in the live market. So if you are doing that, then that will act as a guide for you. Question 5. Even after doing the right analysis, there is a fear to take the trade. So generally the fear comes in two factors. One is you don't know what you are doing. The second thing is you are fearful of losing the money in that particular trade. Since you are saying that you have right analysis, let me assume that you have a good technical analysis. Now coming to the second factor, which means you are fearful as if what happens if you lose the money on that particular trade. Basically, whenever I take the trades personally, I do the proper analysis. But once I put the trade and then put my stop loss amount, let's say if it is 10,000 or 5,000, I completely accept that particular loss. That means I'll assume that that trade is going to get into loss only. So even if the price is coming close to my stop loss, I will not be fearful and then I will not change that stop loss, do the unnecessary stuff and all that, because I am already prepared for it. I know that it is just 1% of my capital or 2% of my capital. Only when you are not ready to accept that particular loss, you will get fearful of not entering the trade, even though you know the correct analysis. So try to accept the loss first. So for that, you should not be risking more than 2%. Even in a better way to say that don't risk more than 1% and then try to take the trades. In that case, you know that you are not going to lose more than 1%. In such scenarios, you will not be fearful to jump into the trades. So that hack you can try it out. Question number 6. My entries are good, but the problem is with exit. Many times I exit with a small profit. Well, this also I have noticed with many traders. They are not able to ride the proper trending market, or even if the sideways market, they are exiting the trades earlier. The moment they see some small profit, they'll exit it. This is the problem that is again linked to the concept called fear. So you are fearful of losing your unrealized profits. So to overcome this, you need to learn about stop loss trailing methods. There are few methods that you can apply in case of a trending market to capture the entire trending momentum, or even in the case of sideways market, you should be knowing when to move the stop loss to the break even, and from stop loss from the break even to 1:1 or 1:2, what are the ways in which you can trial your stop losses. So try to learn these two concepts. I'll try to link, I think I have placed some post upon this particular thing, how to trial stop losses. So I'll try to link that particular post in the description. So check that out. How much the option premium moves when the bank nifty moves by 100 points? See, it depends upon the strike price that you're looking for. Let's say if you're looking for the strike price of at the money strike price will have a delta of 0.5, which means you need to multiply that 0.5 with the number of points of momentum in the underlying asset. In this example, as you were saying, bank nifty, so 100 points into 0.5, which means approximately close to 50 points momentum you can see in your at the money option. Let's say if you're going for out of the money option, like far out of the money option, it can have a delta of 0.2. In that case, 100 points into 0.2, which is 20 points only, the momentum can be there. So as far as you go out of the money, that much less momentum will be there in your options. And this is only the impact of delta. But in the live market, in the reality, so there will be impact of theta as well due to time decay, and there's the impact of vega as well due to IV impact. So you need to consider those as well. Majority of the price momentum happens to delta. Question number 8. How the theta decay works and how it impacts the option premium. See, basically every option will have two components inside that. One is the time value component and one is the intrinsic value component. For example, let's take at the money option. At the money option, let's say if it is trading around 200 rupees, in that 150 could be time value and 50 rupees could be intrinsic value. Let's keep aside the intrinsic value. Let's focus upon the time value of 150. Now this 150, let's say there are 7 days to expiry. Now it is around 150. That 150 will 100% go to 0. It cannot increase, it has to go to 0 only, because all the time value component will have to become 0 at the end of expiry. Now there are 7 days. Now it is 150. Within next 1 or 2 days, maybe it can come down to 130 or 120 or 100 like that. The rate of decrement will be slightly lesser. But as and when it is approaching towards the expiry, the rate of decrement, the rate of premium price going down will be much faster. So that curve will be very sharp when it is close to expiry. And how much decay can happen, that will be told by the theta. So when you go to the option Greek of theta for a particular strike price, it will tell you from this day to the next day, if nothing happens, how much the premium will lose because of the time decay. So that impact will be told by the theta value. And the fun fact is, theta is the only option Greek which will reduce the premium all the time. It will never increase the option premium, but remaining, let's say delta or vega, etc., these things can make the option premium going up or going down, but theta is the only factor which will always bring down the option premium. And many of the option sellers will focus upon this particular thing because that is a sure shot profit for that particular premium points. So regarding this particular topic, I have discussed in depth in the options decoding session. I'll be linking that somewhere on the top or in the bottom in the description. So do check it out. Don't miss that part. Question 9. Can I carry forward a naked CEO option position? Basically, this is the main mistake that I have noticed in many of the options traders, especially the buyers. They will buy either PE or CE and then they want to carry forward for, let's say, 1 day, 2 days, or even till the weekend, etc. The problem is this should not be done. Unless you have a very strong directional perspective, you should never carry forward the option buying positions, that is naked option buying positions, because there can be a huge negative theta decay will be there, which will impact negatively and bring down your option pricing. More on this particular concept I'll be discussing in the upcoming video, which is the top 7 mistakes to avoid as an option buyer. So do turn on the notifications so that you will not miss access to that particular video. Last question. Explain the weekly option selling strategies in a post. Basically, I have already done a detailed post upon this particular thing as to explaining how I deploy my weekly option selling strategy, what is the range that I prefer and how much will be the stop loss, and what is the margin requirement, how do I reduce the margin requirement to the maximum extent possible. All these details has been detailedly explained. I'll be linking that in the description. So do check it out. Those were the 10 questions that we have picked and then answered in this video. If you have any further questions on trading, do let me know in the comments below. I'll be figuring out the comments which got more number of likes or which is more popular or which should be answered. I'll be picking the 10 more questions and then I'll try to do one more Q&A video on a weekly basis. So I'll keep doing these Q&A videos on a weekly basis so that you will get to know some of the important questions that can be helpful for many. And that's it from this video. And do subscribe to the channel, and until next time, this is Arun signing off.